Welcome to the Transparent FX Academy. I'm Nick and I'm a top potter on TradingView with over 190k reputation points. In this video, I will be speaking about the psychology of harmonic patterns. Now, for simplicity, I will be condensing the video into 5 main steps, and we will be speaking about the psychology of each and every of the big categories of harmonic patterns. We will also be speaking about what we can expect after a harmonic pattern is completed, how institutions with their manipulations and essentially hedge funds, so the big players in the market, play a role in the shaping and completion of the patterns. And then we will be speaking by the end of the video on how to use all these informations to your own advantage to potentially improve your own trading plan and trading strategies. So without further ado, let's get straight into it. Okay, so let's start from some definitions. First of all, we have to group all the potential harmonic patterns with all their different names into the 2 main groups. Because as we know from the shapes of harmonic patterns, you have a lot of different patterns, but in the end, they can be categorized in 2 different groups. W formations, in which you have this kind of shape where you have an impulse to the downside, correction, continuation lower, then the market stops and the market makes the move to the upside, or you have an M pattern. Now, that is the exact same concept, simply reversed. Now, it's true you can have a lot of different variations of M and W formations, but in the end, these are the 2 main groups. Either it is a W formation or it is an M pattern. So for simplicity, let's just group them into these 2 different categories, because in the end, what we're interested in here is discussing the psychology of these patterns, how they work, and how we can take advantage of this by understanding how institutions use these patterns to manipulate the market. Now, first of all, we have to identify, and obviously then by the end of the video, we will also go to some actual real-time examples. Now, what we can see here is that in a situation like this, the market was clearly trending to the downside. Then we started the correction. The first thing we have to identify is why the market started the correction. Well, what we know is that no market can just be a bearish market all the time, right? During a move to the downside, any market will need to create these corrections. Now, you may be asking yourself, okay, but why does the market need to create these corrections? Because without a healthy correction, no new sellers can enter into the market. So the whole psychology of a downtrend or of an uptrend is essentially that here sellers are in control. Then sellers start taking profits on their shorts because the market has created a move to the downside. And usually the real players that actually move the market are institutions, right? So clearly institutions, if you're getting a move to the downside, like for example, let's say this one here, institutions were shorting this market. So the market was trending lower, then institutions took their profits and a correction started. Then this gives the possibility to new sellers, potentially new institutions, to enter the market for another leg to the downside. Then again, we have profit taking, the market starts a correction, then this gives the possibility to new sellers to come into the market. The exact same concept applies also for a bullish trend. You have a move to the upside where buyers are in control. Here, buyers start taking their profits, so essentially institutions, the big movers of the market. Then the market starts a correction. Here, this gives the possibility to new buyers, so new institutions, to enter into the market for a new long, and the trend continues to the upside. Now, when you have the creation of a W formation, what actually happened is that when you had the impulse and correction, instead of the market continuing lower, we have a move to the upside, right? That is what creates a W formation, and the move to the upside breaks above the previous high. So it is essentially a failure of a downtrend. Now, what is very important to keep in mind to continue with this discussion is that when you have an impulse and correction, all the retail traders that start shorting the market here if you think about it, where will their stop losses be? All the stop losses of retail traders are usually placed above the previous high. That is what you read in all the books and all the mainstream courses, right? Your stop loss is supposed to be above the high if you're taking a short, right? So if institutions don't have enough liquidity in the market to satisfy all their orders, what they will have to do is go and hunt their stop losses, right? And in order to hunt stop losses, what they will need to do is to create a W formation. That is why W formations are created, because all the stop losses are above this high. So if they want to take a short on a specific pair and there isn't enough liquidity in the market, an easy way for them is to go and hunt all the stop losses that are above a high, and at that point the market can create the move to the downside. So if we have to understand why institutions need to manipulate the market, you first of all need to keep in mind that for every buyer in the market there needs to be a seller. For every seller there needs to be a buyer. Now for retail traders, it's very easy to trade because just pressing the button you can buy any amount, right? But institutions that have huge orders, for them there isn't enough liquidity in the market at any specific time, sometimes to satisfy all their orders. That is when they have to create artificial liquidity by triggering stop losses. Because if you're looking to short, right, if you have a short trade, then essentially your stop loss simply is a buy order, right? Because if you're selling, you want to exit the trade, you will need to buy. So essentially, if they want to sell, for example, and there isn't enough buying pressure into the market, they can artificially create the buying pressure by triggering stop losses of retail traders. And at that point, there is the artificial liquidity in the market to actually enter their shorts. The same exact concept can apply for a buy order, right? If at any specific time there isn't enough liquidity in the market for them to buy the amount that they want to create, what they can do is just trigger all the stop losses of retail traders. That at that point creates artificial selling pressure, and they can use all those sell orders to actually satisfy their buy orders and enter into the market. Now you might be asking yourself, okay, but this has nothing to do with WRM patterns. And you would be very wrong in thinking this, because if you go and take back the pattern, let's say, for example, a W formation, that is exactly what is going on here, right? Because you have the impulse to the downside, the correction, the market starts moving lower. Institutions don't have enough buying pressure to actually sell and continue lower. So they create that pressure artificially by creating a move to the upside, essentially hunting all the stop losses that are above this high here. That creates a W formation. At that point, they have even more essentially manipulation that they can play into this, because many traders, when they start to see the market break above a high, essentially they start buying. And that is exactly what institutions can use to sell and also essentially liquidate their orders that they placed in order to drive the market higher. So that is why after the creation of a W formation, you usually see a correction back down for the completion of the pattern at the neckline, which is the previous resistance turn support, and also the area inside of which we have the stop loss hunting and the manipulation. So that is why W formations are so effective, because they're very powerful tools that institutions can use to essentially manipulate the market, stop hunt, and create this artificial liquidity. So after the creation of a W, you usually have the move to the downside and completion at the neckline, which acts once again as a very powerful manipulation tactic for all the traders that started longing after they saw the break above the high. And at that point, all the stop losses got triggered. Maybe some people essentially started moving their stop losses. If you are inexperienced in the market, that is what most retail traders do. They essentially move their stop losses, which is something that you should never do, because you probably already experienced that at the beginning of your trading. If you're more experienced, that you essentially, or even if you're new and you're doing this, you probably experienced the fact that you keep moving your stop loss, then in the end it's too much pain. You just take the loss, and that is exactly when the market creates the move to the downside. Well, That is exactly what W formations are created for by institutions and market manipulators, because they create a massive amount of pain and manipulate both sides and wipe out both buyers and sellers, creating a huge amount of liquidity. That is why these patterns are created. And that is why they have such a high completion rate. For example, this one here, we can see here how we had the move to the downside, correction, the market then continued lower. And by the way, I did speak about this pair when the market was here. I explained all the reasons for which we could expect first this move to the upside, then from here the move lower, and then from here the continuation higher, which is exactly what the market did. And we will now go in detail in why we expected that. And by the way, I will link these previous analysis as well in the description, so you can go and check them out for more free education. Now, the reason for which the market here had a high probability of making the move to the upside, because in creating the move to the upside, we would have also created this W formation. Therefore, stop hunting all the stop losses above this high, creating the artificial liquidity that then institutions could use to sell. And at that point, trap also all the people that started buying when they saw the break above the high. So you can see that both sellers and buyers got trapped and liquidated out of the market, which is exactly what institutions like to do. And that is why trading is so hard, because you have to know all this kind of tactics. So after this move to the upside, the market corrected at the neckline. Now, when you have a W formation which is completed, and now we spoke about why the pattern is created and why the pattern completes, right? These are the 2 points that we discussed so far. Why is created? To create manipulation. Why it completes? Because that traps also the buyers, and at that point they have the liquidity that they need in order to short back down to the neckline. The third point is how you would expect a continuation. So after the pattern is created and completed, what you would expect next. Now, it is very important to point out that after the creation of a W formation and completion of the pattern, the continuation would be, in most cases, a rejection away from the completion area, which is exactly the previous resistance turn support. So essentially this level here, right? You have W formation, then the pattern completes, and from here, that is where you would expect the market to create the continuation to the upside away from the level. The important thing to keep in mind though here is that if you just had the test of the neckline, even though you have already manipulated all the move to the neckline and the move higher, there is no manipulation around this area, right? You have the test and rejection to the upside. Well, that is where you would be incorrect, because you always have to keep in mind that manipulations can also happen on other time frames, and you wouldn't really see them if you were looking, for example, here at the daily time frame. In fact, if in this area we go down and we see what was going on the lower time frames, let's take, for example, the 4-hour time frame, we can see how we actually had a massive manipulation inside of this area. Look at this huge candle. What do you think happened when retail traders, or even maybe yourself, saw this pattern, right? You see this candle here, which went all the way up here and then immediately rejected to the downside and closed red. Well, if you ask most traders, what would they have done if they saw a candle like this? Most of them will tell you, well, for sure, this is a market that is going to continue lower because we had a massive rejection of the high. So in a situation like this, we could expect more bearish continuation. Well, that is very wrong, because they're looking at only one time frame, only one candle, and they're assuming that it gives the direction of the market, which is absolutely not the case. And that is exactly what institutions use in order to manipulate the market. And that is in fact why after that, the market just continued higher quite aggressively, right? So we actually had the manipulation because all the people that started shorting here gave the possibility for institutions to buy. So every time they were selling, institutions were buying and using them as liquidity to fulfill their orders. And at that point, push the price higher, which is in fact exactly what the market did here. So this is very important to keep in mind. It's not all on one time frames. The same patterns can also have manipulations on lower time frames. So usually after the completion of the pattern, you would expect a manipulation on lower time frames and then the continuation higher. The exact same concept applies also in the case of an M pattern, right? In the case of an harmonic M pattern, you would expect first the completion at the neckline, And then here you would expect a manipulation on lower time frames, and then there you would expect the continuation lower. Now, in some cases, you will see that the market just continues lower here or continues higher here. That is because sometimes the market essentially, they just wanted to create the manipulation above this high, and then they wanted to just push the price lower. Now, you might be asking yourself, okay, but how would I expect if we want to see a continuation or just the market to melt past the neckline? Well, there is a trick for that increases the probabilities that you can understand if the market is going to continue higher or not. First of all, most of the times you will see the rejection, right? However, if you see institutions that are essentially positioning themselves to the opposite side, then in that case, you could expect a break. Now, let's take this specific example here to understand how we could have understood that we could expect more bullish continuation after the completion of this W formation. Well, an easy trick is to look at the institutional order flow inside of the pattern, right? Now, if we go and see what was going on when we look at the commitment of traders, so the COT data, which is what the non-commercials, so the biggest speculators in the market are doing, which are essentially hedge funds, so the big players in the market, and we check the data precisely for the JPY, we can see that inside of this pattern, when the market was around this area, we were clearly seeing that net positions were once again starting to get decreased. We were going from minus 79K down to minus 95K net positions, with thousands, tens of thousands of shorts getting added from an institutional perspective on the JPY. Now, if institutions are shorting the JPY, it means that on the spot, they are actually longing USD JPY because every currency on the spot is traded against the USD. And if they're shorting JPY, they're actually buying USD JPY, so making USD JPY stronger. So if you see a W formation and you see that institutions are actually buying, when the pattern is completed, you could expect a continuation higher because institutions are buying. And in fact, that manipulation that happened around this area led the market into creating the continuation to the upside. So that is an easy trick by using the COT data and the order flow to understand what is the highest probability situation that could present itself after the completion of a pattern, if the pattern gets completed, obviously. Now, how we can take advantage of the completion and continuation of these patterns? Well, that is where it goes down essentially to the own trading plan and trading strategy of every single trader, because this is from a directional perspective, but then there are many specific points that come into the development of a complete trading plan and trading strategy that could definitely be a topic for another video on how to combine everything that comes from a directional standpoint down to an actual strategy. So if that is something that could interest you, make sure to let me know in the comments below, and I could create a video like that goes more in detail. But for now, to keep it just from a general perspective, the usual 3 steps that always have to be followed in creating a trading plan and trading strategy are: first, backtesting and adjusting the strategies to your own trading needs and trading personality, then demo trading until you're consistent, and only at that point you can start thinking about going live. And also, it's always better to look at the higher time frames for the direction and then the lower time frames for confirmations and entries. So for example, if you have a W formation here on the daily, you would go down on the 1 hour or 4 hour or 15 minutes or 5 minutes time frame to time your entry for this move lower. The exact same concept would apply in this area for the continuation to the upside. So you would go on the lower time frames knowing that we have a good probability of going higher, and you would be using essentially your own entry rules in order to trigger a potential continuation higher. So let me know in the description if you would like to see a video that goes more in detail on that, because definitely it's been already a quite long video. I don't want to make it any longer, so I can make a separate video on that if you're interested. And I hope that you enjoyed these quite interesting concepts on harmonic patterns and how to integrate them with institutional order flow to try to understand the psychology of them. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website. Here, you have the possibility to gain access to my entire courses with all the rules of the strategies. You also have the possibility to gain access to one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the COT data software, which is precisely the one that we saw in this tutorial, the trading station software, which puts together everything that you need as a trader all in one interface. And if you scroll lower here, you will see that past the testimonials, if you continue scrolling, there is the possibility to join in order to gain automatically access with the email and password that you will create during the checkout process. So definitely looking forward to have you on board. At least go and check it out at transparentfxtrading.com. The link is also in the description, and I will see you in it. If you enjoyed the video, make sure to smash that like button and comment below. It really does support the creation of more free analysis education and updates for all of you, and I will see you in my next breakdown.